I think this is potentially one of the last Fed meetings in a while where the tail risks are not going to be as thick, where the Fed can actually squeeze in one last easy cut. But we actually think that this time around, while 25 basis points is priced in and well expected, we think that it's actually going to be a hawkish cut. If you look at the projections which we got in September, since then, the GDP data has been stronger, unemployment rate has been lower, core PCE has been hotter. So data in aggregate has been stronger, and that needs to, be taken into account. And you have to add to the fact that next year you have a new president, taking office, which is also going to inject a lot of macro uncertainty, which the Fed needs to digest. So we actually think that, this is actually one of the last cuts by the Fed in a while. Our official call is that the Fed will actually have to pause their interest rate cutting cycle for the first half of next year as the tariffs are implemented and the inflationary shock takes place. So we actually think that Powell will, use the presser to indicate that and actually say that rates from this point onwards are not going to be on a preset path lower, and every meeting is going to warrant a lot more caution than it has.
Wow. Okay. So are we going to see this reflected in the new dot plots, the new summary of economic projections as well? Because as we stand now, I think they're still calling for, 2 to 3 cuts next year.
Yes. So we think that definitely the projections need to be updated. Growth forecasts and inflation forecasts need to be bumped higher. We think that in terms of the dot projection, we don't think that the median dot itself will move higher over the forecast horizon, but the distribution of dots is now going to move much closer together. In September, what we saw was there was a lot of disagreement between Fed members and the distribution bands were much wider. But this time around, we think that this distribution bands will be much smaller, where Fed members who were earlier expecting larger cuts in 2025 and 2026 will now pare them back. And we actually think that the long-term dot projection for the Fed is going to move higher to 3%, and all of that should, combine for a relatively hawkish tilt.
Jayati, I got to say, and I hate to be in the Fed shoes right now because, doing the new SEP, the dot plots, et cetera, I mean, one of the things they're going to have to do is try and handicap what is not known yet until probably Jan the 20th or even shortly after that as well, and what the fiscal side is going to look like.
Yes, absolutely. I think that's why I think that December is probably one of the last easier Fed meetings in a while, because all of next year is going to be very interesting. You have the U.S. economy, which is already in a pretty resilient spot compared to the rest of the global economies. Growth is very resilient. Core inflation is sticky. The labor market is still holding on. And now you will have a president which will be injecting a lot of macro uncertainty. Tariffs will be inflationary. That's something that the Fed will have to assess. I know a lot of people are actually thinking about the growth implications of tariffs. But the interesting thing here is that the U.S., unlike its peers, is not as trade dependent. It's a large closed economy. In fact, China and Euro area's trade dependence is much larger than the US's. That's why even if other countries hit the US with retaliatory tariffs, it's not going to be as big of a growth shock. And that's why we think the first order effect of tariffs is inflationary. And that means that Fed cuts will have to be priced out and the Fed will have to be on point.